Right now, equities are setting non-stop records. We recently saw a 10% jump in just 10 days, shifting the market from oversold to overbought at the second fastest pace ever recorded. But this chart shows a glaring contradiction. On the left, we see that massive spike in asset prices. Yet on the right, everyday consumer sentiment has plunged to its absolute lowest point in 70 years. Adding to that financial pressure, the Federal Reserve recently stepped in and effectively wiped any planned interest rate cuts off the table for the immediate future. That decision locks borrowing costs in place, which effectively freezes the housing market. Potential buyers are trapped by high mortgage rates, and the financial relief they were hoping for this year has vanished. This creates a significant gap between the financial markets and the daily living conditions of most people. While the stock market focuses on future corporate health, consumer sentiment is reacting to the immediate difficulty of affording a home and basic goods. To understand why the Fed hit the brakes on rate cuts, you have to look at the single commodity quietly driving the rebound in inflation: crude oil. This diagram shows the math. For every $10 increase in oil, inflation goes up 0.2%, shrinking economic growth 0.1%. Recently, oil surged from $57 to over $100 a barrel, driving inflation back to 3.3%. With inflation climbing back up and oil prices threatening to rise further, institutional expectations have shifted. This persistent upward pressure is so significant that some market pricing models have now moved the next anticipated rate cut as far out as October 2027. Oil powers cargo ships, tractors, and factories. When it gets more expensive, it acts as a mandatory tax on the entire physical supply chain, delivering immediate, tangible pain to everyday consumers. So why is the stock market completely ignoring this sticky inflation and the delayed rate cuts? The answer comes down to what different groups of people are actually measuring and the distinct time horizons they care about. Everyday consumer sentiment is heavily rooted in the present. It measures how people feel right now about their grocery bills, the price at the gas pump, and their current job security. Wall Street, on the other hand, measures the future. The stock market is a forward-looking mechanism focused almost entirely on corporate earnings and growth projections 12 months down the line. Because equities are focused on predicting tomorrow, they are often less reactive to the current financial difficulties people are living through today. This environment is producing some major anomalies. In a month where the S&P 500 jumped 12%, Bitcoin actually outperformed it, rising 13% as massive institutional money flooded into crypto ETFs. And there is a massive institutional variable quickly approaching. On May 15th, Jerome Powell is scheduled to end his current term at the Federal Reserve. He is expected to be replaced by Kevin Warsh, an official who has openly stated his goal is to shrink the Fed's balance sheet, which translates to less money printing circulating through the economy. This timeline illustrates the historical precedent of that kind of leadership transition. Since 1930, whenever a new Fed chair takes office, the stock market sees an average decline of 16%. When you overlap a surging crypto market with a looming shift in central bank leadership, it creates an environment of high uncertainty. And that is exactly when emotional investors often make their biggest mistakes. Watching the market soar while your own costs go up creates a powerful psychological trap. It makes people want to time their entry or exit to find some kind of financial safety. But look at recent data. Investors who sold out at the bottom, waiting for the macroeconomic picture to clear up, entirely missed out on one of the fastest wealth-generating rallies on record. Attempting to trade based on news headlines is a game that favors institutions. You are competing against hedge funds and insiders who often have the information priced in before the public can react. A more consistent approach is dollar cost averaging. You pick a fixed financial allocation and commit to investing a set amount of money every single month, regardless of the current news cycle. That specific asset allocation needs to be conservative enough that you can hold on to it, even if the market drops by 30 to 50%. While market cycles remain unpredictable, maintaining a disciplined investment schedule has historically provided a path through these periods of uncertainty. Staying invested allows for long-term growth, regardless of the immediate headlines regarding inflation or rate cuts. To keep track of these shifts in the global economy, hit the subscribe button and drop a like on this video.